welcome the CCAC members and thank you for joining us today. As you know, it's not possible to continue to meet at this point, but we are committed to hosting these webinars at the same day and time that we would generally have our CCAC meetings. So please continue to mark your calendar for the second Tuesday of the month, beginning at 12 noon. And as always, I will keep you informed on the program. If you have any suggestions of what you think could be helpful, especially during this uncertain time, if there's someone in particular you'd like to hear from or a topic you'd like us to cover, please do reach out to me. I also wanted to update the members that in addition to our member-only second Tuesday of the month meetings, CCAC, in collaboration with the sister organization, the Alliance for Regional Development, we have launched a webinar series. I know that many of you have participated. If you haven't, I encourage you to do so. We have had off the charts participation. So for those of you that have not been able to log on because we've reached maximum capacity, I do apologize for that inconvenience. We are taping the sessions, so be assured you can still hear the content. And just so you are aware and hopefully following your emails, this week on Thursday at 1:30 p.m. Central Time, we will have the regional administrator for the U.S. Department of Labor. Next week, we have the RTA, Kirk Dillard, the chairman, and Leanne Redden, the executive director of the RTA. And then the following Thursday, so a week from this Thursday, I apologize, I don't have the date right off the top of my head, I think it's maybe the 20th, we have a very distinguished speaker from our CCAC member, DePaul University, that is an expert in pandemics. I have to say that I'm looking forward to getting more history on 1918 and specifically, as well as some other pandemics. There was a book that I wanted to read, and it was sold out on one site and only available in the hard copy. So I thought to myself, well, rather than trying to get my hands on this book, I'm going to just talk to an expert and share that information with our membership. So we have, again, a lot of exciting programming coming up, and I hope that you'll join us. For today, we're going to conduct this very similar to a regular meeting, where in just a few moments, I'll hand this off to our speaker, and he will give a presentation. And then whereas you're normally able to raise your hand to ask a question, today, if you would use the question button that you should find on the right side of your screen, if you send me a question, I will do my best to get to all the questions. We want to make sure that you do feel like you can interact with the speaker as if we were in the room today. So with that, it is a great privilege and pleasure to welcome back Rick Mattoon. Many of our members will remember that Rick was the January speaker. At that time, I thought it was a good idea to ask Rick to give us a forecast of what we should expect for the 2020 economy. And Rick, I have to say, I don't remember you mentioning anything about economic collapse in an international pandemic. So although you might say you failed us then, but I obviously can't hold you responsible for not knowing all of it. And I'm just thrilled that you were able to join us today and help us understand how the world has changed so significantly. And for our CCAC members, just as a reminder, Rick Mattoon is a senior economist and an economic advisor at the Federal Reserve Bank of Chicago. He's in the Economic Research Department, and his primary research focuses on issues that face the Midwest regional economy. Rick began his career at the Fed in 1990. And in 1997, he left the bank to serve as a policy advisor for economic development, energy, and telecommunications to the governor of Washington State. He later served as a director of policy and legislation for the Washington Utilities and Transportation Commission. He returned to the bank in 2001. Rick is on several boards, and he is also a professor at Kellogg. He is smack dab in the middle of a quarter and had to go to the adjustment of not only working from home for the bank, but also working with students all over the world. So again, Rick, thank you so much for being with us today. And I am going to, if you would share your screen now, we'll allow you to start your presentation. And when you're finished with your presentation, I'll come back and ask the questions that we get from the audience. So Rick, thank you.
Thanks very much, Kelly. I think you have to give me rights to be able to share my screen.
I am doing that right
Great.
now.
Terrific. So it's my pleasure to be here today. I want to thank Kelly for giving me the opportunity to talk to you all today. This is certainly a different time. Usually when I do these talks, I always get a free lunch out of it. This time, I don't even get my free lunch unless Kelly has managed to arrange for me to have Jimmy John's come by after this talk is over. So I titled today's presentation, The Economic Outlook During Uncertain Times. I want to stress two things before I get going. The first is my usual disclaimer that the presentation represents my own views, not those of the Federal Reserve Bank of Chicago or the Federal Reserve System necessarily. And the second is that I want to be extremely conscious of whenever talking about this as an economic phenomenon, we also have to recognize sort of the healthcare dimensions of what we're going through right now. This is obviously a extremely stressful time for many families and many people throughout this country and throughout the world. And we want to be extremely sensitive to the fact that this is primarily a health phenomenon. And so therefore the tragedy that's causing to so many people is something that we always want to keep in mind. So first, let's start with a framework for thinking about the impact of COVID-19 on the economy. And that's part of what I want to do today is talk a bit about how to think through the issues of modeling the economics of this kind of an event. As Kelly said, I did talk to you in January. And in January, what I told you was there was a remarkably broad consensus among almost all economists that the US economy was setting itself up for a year of above trend growth, but slower than we had seen in 2018 and 2019. So expectations were for GDP to come in somewhere around 2 to maybe 2.2% for the year. One of the things I also commented at that time was it was remarkable how consistent most economists were in making this prediction. And I believe I told you that that should give you some concern that everybody was so on board in terms of where they thought things were headed. The key to this expectation for this sort of above trend growth was really the consumer. The idea is that if you looked at what was driving the economy, particularly towards the second half of 2019, it was consumer spending. Businesses had stayed somewhat on the sideline, but the expectation was that with low interest rates and very tight labor markets and increasing wages, that the consumer would continue to be sort of the driving force of the US economy. And that was the expectation that that would continue. There also was a sense that some of the trade frictions might lessen during 2019 into 2020, and that might increase some business investment. So that was the sense that there was a very sanguine outlook, a sense that there were very few sort of major downside risks to economic growth, and everything looked like it was sort of on sort of a smooth trend path in terms of that. Okay, so what happened? So obviously we had a pandemic, and the way I would like to have you think about COVID is in many ways it's a black swan event to economists. What you have to understand is people went through a series of different exercises to try to understand how the economy would respond and recover to something like a pandemic. And this is a very uncertain exercise, and there isn't a lot of data points to be able to point to suggest how you should think about this. The first thing is a lot of people start off by trying to model kind of where we were relative to what had happened coming out of the Great Recession or even the Great Depression. But this isn't really like a recession. in many ways, even though you're having very recessionary impacts. The reality was the Great Recession was caused by over-leveraging of the financial system, some bubble-like activity, in particular in housing markets. And so therefore it was largely kind of self-inflicted. Great Depression, similar. You had a situation in which you had sort of things that we had done through policy or through markets not adapting properly that suggested that this was sort of self-inflicted pain. The second template people used was this is like a natural disaster. So they suggest it was sort of like a hurricane. The hurricane shuts down economic activity, but the difference with this and a normal natural disaster, if you can call anything a normal natural disaster, is the duration is usually pretty well known. You have a sharp downturn, but then you have a sharp recovery coming out of it because you have some finality in terms of knowing when the event's going to be over. This time around, we don't really know when all the effects of the pandemic are going to be played out. And so that makes the duration of this event very much an open-ended question. So the other thing too is the impact of any crisis, and particularly this crisis, is being felt very unevenly. Exposure really depends on a number of ways in which how exposed you were going into this to this kind of an event. So different industries are obviously far more exposed than other industries in terms of how they're reacting to this. Different governments are also widely differently exposed depending on what kinds of revenue systems they have. So what this has led to is, as opposed to that very sanguine, very certain forecast you had going into this, at this point you have a wide range of forecasts suggesting a wide number of different scenarios for how this will play out. So the first data point we got was the first official GDP estimate, which came in last week. And that had US GDP declining at 4.8% on an annualized basis in the first quarter of 2020. Obviously, that understates the impact of the event because much of the impact didn't fall until the last month of the first quarter. So therefore, you expect a much worse second quarter coming out of this. If you look at this, this is 9 different private sector forecasts that have been done on the annual percent change in GDP. And as you can see, there's a really wide range. So to an extent, you can kind of pick your favorite forecast depending on how bad or how long you think the event's going to happen. So if you look at the top line, that showed a median projection, the first quarter GDP coming down about 3.6%. So it was a little worse than that, but that was certainly in the ballpark. That same group of median projections comes up with a 34% drop in second quarter GDP, which obviously would be a record level. But it also forecasts a fairly quick rebound with a 9.7% recovery in the third quarter of 2020 and a 10% recovery in the fourth quarter. So it suggests that while there won't be a sort of an automatic snapback, it suggests that the second half of the year will show significant growth after this very sharp downturn in the first and second quarters. If you look at the more optimistic forecast, you come up with a softer decline in the first quarter, which obviously didn't materialize, a somewhat softer downturn in the second quarter of 24.5%, still massive, but then a much sharper recovery, 35% up in the third quarter, 15.7 in the fourth quarter. And among the most pessimistic, you can see that you're looking at a 45% decline in the second quarter, only a 0.4% recovery in the third quarter, and then a very shallow recovery of only 3.2% in the fourth quarter. So there's a wide range right now of where professional forecasters are expecting the US economy to sort of settle out. So a fundamental question I think you need to think about is this a liquidity event for firms and governments, or is it a solvency event? For some, particularly those who entered with large reserves and were less economically exposed in the sense that they have less sensitive revenue sources, it's more likely to be a cash flow and a liquidity issue. They're clearly seeing a decline in revenues because they simply can't get the same level of business right now. But if they can tide themselves over to a period of recovery, things will sort of balance out. Again, it'll be a cash flow issue, less of a sort of a shutdown issue. issue. But for others, and this is the ones that we're most concerned about, it's both. It's more than just regaining revenues that were lost during the period. It's a sense that in many cases, they're going to have to radically alter their businesses simply to stay in business. And in many cases, they will never recover the level of revenues that were lost during this period of time, and they might be exposed to a permanently slower set of circumstances coming out of this. So all this is predicated, and I think we have to start with is some idea of how consumers will react when it returns to a new normal. So if a consumer was going to be the driving force coming into this particular period of the economy, you really have to come up with some sort of a scenario for how consumers are going to behave once sort of the nation sort of more reopens. So I'd like to suggest this is probably a good time to think about behavioral economics. One of the things that economists learned, and I think with caused great humility, was during the Great Recession is that people didn't do what the economic models wanted them to do in response to the sort of the conditions that we saw coming out of the recession. So theory would have suggested that when the policy response was to institute very low interest rates and to have large federal stimulus through the ARRA, that consumers would not only spend, but they would take on debt. They would recognize that the conditions for taking on debt were super favorable. They'd leverage up and firms would do the same and the economy would sort of take off coming out of the Great Recession. However, behavioral economists saw a shift in consumer thinking. What they saw was that the risk appetite for most people and even for firms had really sort of diminished. What became sort of the accepted behavior was to deleverage and increase savings. So even if you were suggesting to people that it was a great time to, to leverage up on debt, they simply didn't do it, even though the conditions were favorable for doing that. And so what this meant was is that firms and even households started to suggest that having reserves was more valued than pushing the limits of growth through higher leverage. So you saw this behavior in which savings became sort of a primary objective, both of firms and of households. So what's going to happen this time around? Again, I'm going to put this as a great time for humility. The best you can do is create some scenarios and then use those to sort of inform, again, how behavior is going to respond to those. So the best case scenario I would suggest is an effective vaccine or herd immunity becomes available relatively quickly, by early fall, say. The risk of COVID infections drops to near zero. People have confidence that they can go back to their pre-COVID lifestyle. And now that you could sort of predict a V-shaped recovery. Any sort of, spending that had been put off will come back rapidly as people are very confident about where the economy will be. The intermediate case is a vaccine is still in development, but there's an effective treatment protocol and maybe minimizes the death toll and the impact on the healthcare system. Social contact is less risky, but you still have to have some measures to limit spread going forward. So you have some recovery of economic activity, but it won't be full-on economic recovery. And I think that's right now what a lot of people are seeing at this case, this sort of, it fits and starts sort of return to some sort of higher level of economic activity, but clearly nothing close to what it was prior to the pandemic being really introduced into the US. And the least good case is there's no vaccine or effective treatment protocol developed. And there's also an inability to have consistent contact tracing and effective testing to be able to sort of at least monitor where the flu is spreading, where the event is, where you can't really restart the economy because second waves of infections are becoming common. I term this as the Spanish flu model, which is the US thought they were through the Spanish flu, and what ended up was having a second wave that happened in the fall, which was actually killed more Americans than the first wave did, so a higher concentration after people thought that things were all clear. So those are sort of three scenarios to think through. Okay, so let's get a bit more specific. Where's the impact been most noticeable? Where is it showing up in the economy? Well, clearly the labor market, extremely high unemployment claims, very high unemployment rate numbers. Financial markets, you're seeing increased volatility, fund outflows out of things like many things, particularly sensitive markets have been really challenged. Governments are having a combination of both declining revenues and a spending shock in various categories. Consumers appear to be behaving by sort of hunkering down and increasing savings. And then I want to talk a bit about which industries are most exposed and also talk about where the geography of those industries are located. So the first thing, so this is a slide that in the best of times would not look something like this. So what I tried to do was actually smooth the exposure, the sort of spike that's occurred in continuing claims for unemployment insurance. This is a 4-week moving average, but as you can see, even with trying to smooth this, you see just how extreme this event is. I mean, it was literally almost off the charts in terms of how the line spikes. Again, even trying to smooth the behavior going forward, which is just showing how many people have been thrown out of work and how greatly expanded unemployment claims are at this point in time. If you look at the next thing I want to think about is volatility. And financial volatility, again, has been sort of unprecedented. And it shows, again, sort of concerns about sort of conditions of markets freezing up over periods of time. And, while it has trended down, we're still at very elevated levels of financial volatility. And this is using the CBOE's VIX volatility measure. Before, if I had talked to you again going into January, I would have suggested that we had heightened volatility in, say, August of 2019 and a little bit of November of 2019. But as you can see, those levels were at slightly above 20. We're looking at levels above 80 at the most extreme part of this. So again, we're seeing volatility being something that's really wreaking havoc with how markets are going to behave. The one bit of a surprise of this has been the recovery of the stock market. After this very sharp sell-off, you've had sort of strong recovery. And there's a couple of theories about this. One is the sense that um, firms basically that are going to be able to weather this particular event will recover in a reasonable way, and they're going to be bolstered by, virtually zero rate interest rates coming out of this, the ability to sort of be able to sort of ramp up operations fairly quickly. And so therefore the recovery is, maybe this is forward looking in terms of an expectation that there's sort of light at the end of the tunnel, but stock market recovery is certainly paced far ahead of anything else that's been happening in the real economy at this point. Okay, so this is the consumer story. So this is the thing that probably is the most noticeable right now in the economy, which is consumers just stop buying. Again, you have a major shock, you have a great deal of uncertainty introduced into the economy, and how do consumers respond? They hunker down. So retail sales really dropped, and this is, through the March numbers, and they're going to get worse, obviously, in April. So you see this very sharp decline in retail sales, and you can see it particularly concentrated in particular markets. So while all retail sales were down 8.7%, clothing stores were off almost 51%, furniture stores 27%, same with auto dealers, basically the same for restaurants and bars, sporting goods down 23%, department stores down 19.7, and gasoline sales down 17.2. So really sharp declines. And again, the April numbers will be worse than this in terms of these sales levels. And again, this gives you some sense of which particular retailers are most exposed to this current environment. The only good news in retail sales were drugstores, which actually saw an increase. Online retail, not surprisingly, was up. And then building and garden stores actually had an increase, as it seemed that people, when they were stuck at home, started doing more DIY projects. So that was a little bit of the good news. So what's the response when you stop buying stuff? Well, you start saving money. So if you look at the US savings rate, it explodes. Now, again, going into this period, the US savings rate was relatively elevated. We've been running prior to the Great Recession a savings rate of around 3 to 4%. They've been running around 8% throughout this period of time through the 2019. But as you can see, by March, it spiked to over 13%. So people are clearly nervous about things and they're saving money as rapidly as they can. And that obviously means less money being deployed directly into the economy. Okay, so let's get a little bit specific. So which industries are most exposed? Brookings has done a lot of good work on this. What they showed is they suggested that these particular 6 industries or 5 industries are the most exposed in terms of highest risk industries: mining, transportation, employment services, travel arrangements, and leisure and hospitality. They employ about 24 million Americans, 16.5% of all jobs. And they suggested that these are industries where you'd see, really sort of super high levels of layoffs and, sort of protracted effects coming out of this. If you look at this from a geography point of view, it's heavily concentrated. Again, the darker the red, or the pink color, the heavier the concentration is. It's Sunbelt tourism destinations, obviously, since hotel and hospitality has been pretty well shut down. So anything that's a hospitality center has been shut down. And then the collapse in gasoline prices really exposed energy metros to significant problems. And you're seeing that again throughout Texas and any of the places where you have sort of significant gas operations. But as you can see, it's broadly spread across the country. Again, we have later exposures depending on the industry mix, but the sense is these are kind of a sort of a map of where the COVID effects are being felt, particularly within metros. If you look at large metros, they're the ones that have been most exposed to particular outsized job losses. Again, these are very early numbers, but as you can see, 10 very large metros, including Chicago, have seen, huge job losses, 38,000 in Chicago Metro. And, these are of concern because, again, these are places that are key to economic activity. You're seeing this sort of very outsized kind of job declines within these particular metropolitan areas. If you look at where unemployment rates are rising the fastest, again, it's going to be mostly the western and southern metros. And that's again because they're exposed to tourism and energy economies. But again, if you look at this, the darker the blue, the faster the unemployment rate has risen in those particular places. And clearly Chicago still is in that sort of third tier of one that has seen, faster growth than say many of the areas throughout the Midwest at this point. So an interesting exercise that Brookings also did, and this was actually work that Mike Pagano at University of Illinois Chicago did, was he combined sort of how cities were going to be exposed by looking at their revenue mix and then layering in this share of metro employment in these high-risk industries to come up with sort of a measure as to how exposed cities are from both a fiscal and from a sort of economic structure point of view. And the interesting thing you'll notice in this is, first of all, there's a lot of Ohio cities on this. Now you can see what dominates this is they're highly exposed to very elastic revenue sources. Ohio is more dependent on, particularly on income taxes, personal income taxes for funding local government than almost any other state. States that are more property tax dependent, like Illinois, tend to be less exposed from a revenue shock perspective going into this recession. So they're somewhat cushioned in terms of the immediate effects it's going to have on their governments. So this shows you again sort of governments that tend to be more reliant on sales and income taxes and less reliant on personal income tax and on property taxes. And it shows their sort of exposure from a fiscal perspective. If you look at Midwest cities specifically out of this grouping, Chicago ranked 81st out of 140 in terms of exposure. And this is because it has a fairly inelastic revenue base. So therefore, it has less revenue exposure, not a high percentage of its tax base comes from very economically sensitive taxes. Mayor Lightfoot has mentioned that only about 30% of the revenues for the city are what she termed economically sensitive. And this means that the effects of the impact will be more midterm rather than more immediate. Whereas you can see in Detroit, Indianapolis, and Grand Rapids, you have much larger shares of general fund revenues coming from elastic sources. fairly decent exposure in terms of industries in high risk categories, and so they have a much more immediate exposure in terms of being affected by the pandemic. Again, this is just a map to show you kind of the geography of this. Again, darker blue is bad in this case. You're having the more immediate effects. Then you can see which cities are sort of more exposed from a fiscal perspective coming into this particular pandemic. So what's government done so far in response to this? Well, the answer is a lot. Clearly the CARES Act was $2 trillion worth of spending, a second installment of 1.2 trillion. Much of this is in the PPP funding to try to help out small and mid-sized businesses. The Federal Reserve has opened up a number of different lending mechanisms, everything from the Main Street lending program to now the municipal lending facility, all trying to lend sort of liquidity support to both businesses and governments. The Fed cut almost immediately the Fed funds rate from 0 to 0.25% and has made a commitment to sort of maintain very low fund levels until you have some sort of a significant recovery. And again, this creation of new facilities going forward to sort of bolster particularly market operations at this point to make markets function more efficiently. So let's turn to Illinois. So Illinois' impacts are been pretty extreme. So the governor's office has estimated that revenues will fall about 2.7 billion short for the current fiscal year and 7.4 billion fiscal impact in FY21. The state has gone ahead and tapped a 1.2 billion line of credit. It's been in the process of trying to issue bonds, although it pulled the bond issuance it was going to try to do last week because simply the rates they were going out at were just too high. They break down the estimated revenue decline in FY21 into 4.6 billion in lost revenue due to economic activity declines, 1.6 billion needed to repay short-term borrowing, and a loss of 1.2 billion if the graduated rate income tax proposal is not adopted, which had been kind of priced into the FY21 budget. The Commission on Government Finance and Accountability, COGFA, estimates that there'll be a 2-year fiscal decline of about 20% of revenues. That'd be twice was experienced by Illinois during the Great Recession. There have been several suggestions for how to close the budget gap. They include skipping the state's payment into the pension system, which is currently about $9 billion per year, increasing the state's bill backlog, which is currently around 7.9 billion, cutting aid to local governments, furloughing non-essential workers, creating new state revenues such as creating virtual casinos or adding a surtax on delivery services. It also should be noted that this isn't being unnoticed by the rating agencies. The entire state and local sector has been put on sort of a negative outlook at this point, so that's not really new. The new one was that Fitch downgraded Illinois debt to BBB minus, basically putting it in line with all the other ratings agencies, which have now Illinois one notch above junk. And this will have real effects if Illinois does actually slip into junk status. And with a negative outlook, it has a greater risk of doing that. So the question is, does Illinois have any cushion built in? Well, on the good news side, both Chicago and Cook County do have budget reserves to draw on. Cook County is more exposed than Chicago because it has more economically sensitive revenues, mostly because it runs a large hospital. Because it's losing so much revenue at Cook County Hospital at this point because elective surgeries aren't available. That exposes the county to a bigger revenue hit than Chicago. Illinois, on the other hand, entered the crisis with virtually no budget reserves, 7 billion plus in unpaid bills and 140 billion in unfunded pension liability. So that's a significant issue. And then obviously the other thing is it's now more open-ended as to how voters are going to respond to this proposal to actually create a graduated rate income tax structure in Illinois, which was designed again to sort of boost revenues for Illinois going forward. Whether that passes or doesn't is probably more of an open question. So this is something Moody's put together. This is just to show you sort of a way to think about this, the two stresses that governments are facing at this point. The one is a tax revenue shortfall, and the second is an increase in spending in two categories. One is Medicaid, and the other is unemployment insurance payments. In both cases, there's no way that local state governments could have anticipated that their Medicaid caseload would explode the way it has, nor that its unemployment insurance caseload would also explode at the same levels. So they're seeing extreme sort of gaps in spending going forward, driven by these unanticipated costs that they really couldn't have insured themselves against. So when you combine in this case, and this doesn't include the uninsurance cost increase, only the Medicaid expense. If you look at Illinois, what you see is a 13.1% drop in terms of revenues, a revenue shortfall, which translates into $5.1 billion of unrecognized revenue or a loss of revenue, 2.7% increase in the Medicaid spending level. That's even with an increase in the federal matching portion of that, which translates into $1 billion of unanticipated spending. So a combined fiscal shock, they're estimating, of about 15.9% of the general fund, or about $6.2 billion. As you can see, the other states in the region are in better condition in terms of that. They had perhaps less of a fall in terms of their revenue levels, but they also have in many cases maybe lower increases in terms of Medicaid. The other thing that you can look at is the reserves going into this is also on Moody's basis, their analysis on two scenarios, sort of a baseline and then a severe shock scenario. As you can see, Illinois was clearly the most exposed. They had very little cushion going into this. So even under the baseline scenario, they had estimated to have a very large budget gap relative to other states that again can draw on reserves to sort of cushion this. And in the severe scenario, it becomes particularly ugly, suggesting almost 20% budget gap going forward. So Illinois has very little cushion going into this. So final thoughts, and then I'll be very interested to hear your comments or questions. McKinsey did an interesting analysis, and they suggested one of the things to think about is in recovery is we're going to enter into what they call the resilience economy, which is there's going to be a higher and higher value placed on both businesses and governments to building in higher levels of resilience to economic shocks. So again, this suggests more savings, more reserves, less risk-taking, again, sort of a de-risking of the economy going forward. And that has indications for how the economy will perform in the years ahead. This could be a significant event in changing sort of behavior. Another thing is to think about what happens to cities, and I know this is an active debate in blogs and in any number of articles at this point, which is density obviously helps pandemics spread, and cities are based on making density an advantage. So if density is perceived all of a sudden as a bad thing, does that challenge kind of one of the fundamental advantages cities have to offer, which is putting people in close proximity to each other, allowing knowledge to sort of spill over in sort of very close ranges to be able to again make geography an advantage. Maybe that's going to be a challenge going forward. Maybe you're going to de-densify cities going forward. Another thing clearly is telework's becoming a new reality, and an issue is, are people really going to sort of warm to this simply by having been forced into it? The reality is that you may not see people fully return to offices again. They certainly won't return in the same numbers. In many cases, you may see employers doing things like only bringing back 25 or 30% of their workforce into their building on a sort of rotating basis. So maybe you go to work maybe 2 or 3 days a week into downtown. You don't need to be there every day. It's clearly going to have a significant impact on transit if you don't necessarily need to move that many people on a daily basis in and out of the city. That's going to be an effect. Clearly something I'm sure you're all thinking about is, businesses move very rapidly to open floor plans. The whole idea again was density, that you were going to put sort of have people have fewer square feet per worker. Now that doesn't seem like that's going to be a reasonable approach going forward. Firms like WeWork, co-working spaces were entirely designed on, again, having very dense floor plans. And now you may have to socially distance or recreate cubicles or other things where you're not necessarily going to be able to have the same sort of floor plan goals that you may have wanted to do 6 months ago. And then the last thing is we saw this coming out of 9/11, which was companies all of a sudden had to spend a lot of money on security, whether it was metal screeners, increasing security around their buildings, all sorts of things. And now you're going to have spending on healthcare screening devices. It's not going to be just metal detectors. So you're going to have a situation where you might be looking at now, looking at these other sorts of costs that you hadn't had to anticipate in the past. So with that, I think I've given you as much of an uncertain outlook as I can possibly give you during this period of time. Again, anxious to take your questions or hear any comments you might have. So Kelly, I'll throw it over to you.
Thank you, Rick. And if you want to stop your screen sharing, then we can have a conversation. And I do want to remind our attendees that there is a question button on the right-hand side of your screen. Please do send your questions. You can also email them to me if you absolutely cannot figure out the question button here on GoToMeetings, but it'll be a lot easier for me to be sure to get to your questions if you send them through the screen. So Rick, we do have a few questions, and the first question is from a member who is an economist, and one of the issues that he finds most concerning is the situation with the dramatic increase of the Federal Reserve balance sheet. The question is, how is the Fed planning to unwind its current balance sheet size? And very connected to this question, how concerned are you and the Fed of possible increase in inflation in the coming months?
Yeah, it's a good question. I mean, one of the things, obviously, we significantly expanded our balance sheet coming out of the Great Recession. And, part of that was we, essentially went to quantitative easing as a strategy for monetary policy. And this is clearly another example of that where we've expanded our balance sheet significantly. There's a couple of things. First of all, we did have some experience with decreasing our balance sheet prior to this event. So we were drawing down the level of the balance sheet prior to this, and we're using the balance sheet as another monetary tool going forward. So we had the ability to, mostly, I think the biggest interest we have is not surprising anybody in the moves we're making when it comes to reducing our balance sheet positions. What we tried to do previously was make a regular schedule of what assets were going to roll off and at what time. So the market had full knowledge of this and could absorb this change in behavior. My expectation would be that that would be the same thing we'd be seeing this time, that we would create a sort of a schedule for how things would be falling off of our balance sheet. In terms of the inflation question, it's a good question. There was a great deal of concern this last time around that would occur, but you saw sort of larger macro factors working against that, which was simply you didn't see a significant pickup in wage inflation and you didn't see a significant pickup in commodity inflation coming out of this. So this change in balance sheet behavior didn't seem to ignite any sort of inflationary reaction coming out of this. This time around, it could be the same situation where you could have softness in both of those areas, both wage inflation and commodity prices, which would make it suggest that you wouldn't have sort of any immediate effect in terms of the balance sheet sort of being inflationary in terms, just by it in and of itself.
Great. And the second question, really kind of building on that, is how concerned are you, and if you think from your colleagues at the Fed, that we would reach negative interest rates, and what would be the implications of that happening?
Right. So we've gotten that a lot. I mean, obviously, since we're now pretty much at the zero bound with a 0 to 0.25% Fed funds rate, we're obviously hovering just above that. I think the communication from the Fed has been fairly clear, which is we don't necessarily think of negative interest rates as being an effective tool or one that we would want to primarily use at this point. Obviously, several European central banks have experimented with negative rates. Their history hasn't been, terrific, and they've had a hard time getting out of those positions once they have. We think we have other tools that are actually more effective. Again, whether it be quantitative easing or forward guidance. So I think even the most recent, I even saw a comment, I believe, yesterday from Chairman Powell saying that he didn't think negative interest rates would be an attractive option for the Fed to follow.
Okay. Next question is, what about reshoring and supply chain disruption?
Yeah, so interesting enough, as you can imagine, we're doing a lot of talking to people right now. One of the great things about having this kind of event is you realize that, data really doesn't help you much. So for the most part, the data comes in well after everything's happened. So much of the best information we're getting is from talking to people directly. And, among particularly manufacturers, several of them have said that if they have domestic supply chains right now, they've been less affected during this period of time, and they're sort of more confident going forward. So they said that the concept of would this potentially accelerate reshoring, it'll certainly make people take a look at it for sure, because again, I mean, it's those large stretched international supply chains that have really exposed a lot of businesses to having to go through a difficult time, trying to get production up or trying to maintain production. So I think it will be something that will get more attention going forward.
Okay, thank you. Any comments on the US reserve currency status? Is it at risk? What should we do to protect it? How will the Social Security Trust Fund shortfall loom in this analysis?
Yeah, I think, again, I know there's always been a concern about this. I mean, sort of the sense of is the U.S., is the dollar going to lose its, be the sort of anchor currency of international business. I don't think there's much evidence right now that that would change. I think again, as you show willingness, particularly more so before this event, but international. Purchasers of U.S. Treasuries. I mean, there's still a sense that the Treasuries, the bellwether economy, and one of the things we also have seen is despite whatever's happened, the US economy has actually outperformed most other world economies throughout this period of time. So it's still been, even in a period of slow growth, the better bet relative to other places. So I think that there's not a great deal of sense right now that the dollar would be in jeopardy as a currency. But it's always a good question to ask. And obviously, a lot of the sort of rules of the past maybe won't hold going forward.
Okay, thank you. The next question is, construction is full speed ahead. Chicago went to great lengths to keep it without interruption. How has that kept us afloat? What if it closes down like a few other cities did?
Yeah, I mean, construction is obviously key, and one of the advantages is, ironically, I mean, you've had this, two tensions. I mean, on one hand, it's a great time to do a lot of construction because there's not congestion in places. I mean, if you want to do road projects, this is a great time to do road projects because people aren't driving that much. So it's even a more efficient time to do these things, and it's also a bit of an opportunity because one of the things you also have to think about is what policies do you want to have in place to speed recovery once we get back to the sort of more normal behavior. And construction and infrastructure is going to be a key component of that, right? So, it has a big multiplier in terms of its economic influence on the economy. And so you want to be able to make sure that those projects, if, either are going, will continue to go, or can even ramp up faster once sort of more normal activity occurs. So it's a key sector, from a policy perspective as to how we shape recovery. Parenthetically, I'll know like some cities, for example, have said that this is a good time to think about new infrastructure, new construction, things like rolling out 5G networks and things like that. Again, as an opportunity to build future productivity into the economy, at a time in which this might be a time in which you have super low borrowing costs, so you can again take on debt to do these kinds of projects.
Well, and what is the latest? I know there was conversation in Washington. It sounded like both the Trump administration and the Democrats were interested in a infrastructure bill. Have you heard anything about where that may stand?
It's gone back and forth. I think it's one of those things that you always hear, that there's broad bipartisan agreement on the value of infrastructure. I think it's an issue again that who pays for it. How it's going to be shared between the states and the feds is a key issue. And obviously, one of the issues we're seeing in talking to states right now is they're very reluctant, obviously, to take on debt. They have large shortfalls. They're seeing their revenues fall. So even things like in Illinois, a major feature of this year's economy in Illinois was supposed to be the rollout of a significant capital spending program. That's going to have to be trimmed back. Gasoline tax revenues, even though we increased the gas tax rate so dramatically going into this year, have fallen 40%. So you simply don't have the revenues to support the construction or the bonding right now in the short run. So that's going to be something people have to look at.
Makes sense. One of our board members has submitted a question, and it is, has the Fed modeled the impact on revenues in Illinois? If and when a graduated income tax is passed, of a meaningful acceleration in the exodus of higher net worth residents form the state. And the second part is, there are many who are tired of paying the ever increasing real estate taxes they are already exposed to, and now with the thought of having to pay higher income taxes targeted at this specific group of people, it's not going to be of interest. What are your thoughts?
Yeah, we haven't done anything specific. I mean, I've certainly read enough studies on this, and I think the point's well taken. I mean, I think that you've got to understand some sort of sense of like just how sensitive are people to tax rates, and clearly at some point maybe you reach a point in which people are so sensitive, or they have other choices as to where they could live, or where they can do business, and if the tax differential is high enough, they may well use this as a reason to change where they want to be domiciled. If you look at various states, you've seen some states have had, Connecticut has had some outflow because of high tax rates for certain classes of workers, very high income workers. Again, it's not without reason to believe that that wouldn't necessarily occur. You always have to balance this off though against, again, sort of like quality of life issues and the services that are being provided through those taxes. So it's not as simple as you have the highest tax rate and therefore that immediately drives people out, because you can move to lower tax jurisdictions that simply just don't have good government services, and that can make it not that attractive to be there. The one counterpoint I'll give to the opposite is always the case I use, and this is always not a great example, is Minnesota, right? So Minneapolis has been the fastest growing city in the Midwest for the last 2 decades. Minnesota has the highest tax rates of any state in the Midwest by far. And yet that hasn't held them back in terms of growth. But the idea there is when you talk to business people, it's that the taxes support services that they highly value. Which is good infrastructure and good education. And so the idea is I'm willing to pay higher taxes if I get services I value. If I'm not getting services I value, I'm just paying higher taxes, that's not a very good proposition. And the last thing I'll say, just to sort of reinforce the point, is I think the biggest issue for Illinois is higher taxes going forward aren't going to buy you new services, because we have this large unfunded pension liability. You're paying higher taxes to pay for something you've already consumed. So the higher taxes don't translate into better services, they translate into paying off a past debt. And that makes it even less sort of economically attractive. So I think I've talked around that one as best I can to show that I'm a legitimate economist. I've answered all sides of that question effectively.
And Rick, I remember in January when this question came up, and I believe it was part of your presentation, that you showed that people that were exiting Illinois were leaving and going to some states that were
Yeah.
equal or higher taxes.
Yeah.
So that there was kind of some confusion about why they weren't just leaving because of high taxes.
Right. If you look at economic studies, I mean, people leave for economic opportunity, right? So if there's a better job in California and they're going to pay significantly higher taxes, they're still going to take the job in California, which is where a lot of the people who are leaving Illinois were going to. So it's again, it's a sort of a highly complex question, which has lots of layers to it. Which economists love, but frankly frustrates pretty much just about any normal person.
But we're going to go on to the next question, and that is, what are the implications for Chicago's recent tech sector growth?
Yeah. I think, the tech sector has obviously been one of the really great success stories for Chicago. I mean, if you looked at even just a decade ago, there was virtually no tech employment in Chicago, and Fulton Market was still just a market basically. And you look at how explosive the growth has been there, and it really has put Chicago on the map. Again, it takes all the advantages Chicago can offer in the sense of it's a lower cost place of doing business than say Silicon Valley or any of the other sort of tech heavy places in the country. You have great opportunity to recruit workers into this sort of very vibrant community. And the explosion of growth there was really terrific. The problem today is you're seeing that these are the same, tech companies are service companies. And, one of the things you're seeing is people who are most exposed from an employment perspective to this particular pandemic are service workers. It's the service workers who are getting laid off. So it's not surprising that you're seeing service companies say, look, our business model doesn't really work when we can't sell into the market. I believe yesterday I read in Cranes that like Glassdoor is doing a significant layoff in Chicago, and partly is because they don't. It's mostly salespeople. That their salespeople don't have anybody to sell to right now. It's not that the business model is wrong. It's just the business model can't work in this environment. And a lot of, service-facing tech companies are facing similar issues. The
Sure.
backbone infrastructure guys, not so much. I mean, everybody's obviously, building out their tech abilities as quickly as possible. So, if you're on that side of the business, you're doing just fine.
Great. And for our members, we did interview Howard Tallman just last week on our webinar series. He was one of the leaders of 1871. And if you did not have a chance to watch that webinar, we do have a link, and I'm happy to send it to anyone that emails me. We'll also post it on the website. We do have another question, and that is, do you think the contemporary version of the WPA is a possibility to rebuild infrastructure and to invest in such programs as high-speed trains?
Okay, well, that's a great question. I have seen that mentioned by some people. I mean, the one thing that supports it right now, the notion that you could go out and create some sort of an entity to do particularly infrastructure investment, is largely around the fact that you have super low borrowing rates right now. The federal government can go out, 30 years out at the lowest rates they're ever going to see. And so this is a perfect time to sort of do those sorts of major infrastructure investments. And the idea is that the federal government is the only one that actually has those kinds of rates available to it. So if you were going to do some sort of a major building project to sort of, again, sort of, really sort of create, the infrastructure of the future, you kind of have a window right now to do it. The clear issue here is people are concerned about just, what is the debt threshold for the U.S. economy, right? You can't just unlimitedly borrow, even if the conditions are favorable right now when we are taking on so much debt at this point relative to our economy. So it's a balancing act between those two things.
But what about to the part of the question about the PSA, and maybe explain that to the audience members that don't know what they're talking about, back getting out of the Great Depression.
Yeah, so Yeah, so the idea there was that, unemployment was super high, and part of it was to put people to work. So you would create these work projects, programs where you would put people to work in communities to build roads, electrify large parts of America, do all sorts of things. And it obviously had, it was a labor employment, program in some ways, and it's the infrastructure program also. The hope is at this point is the employment effects of this are going to snap back a lot faster, that as companies see revenues come back, that if you talk to people in surveys of the people who are currently unemployed, roughly about 75% of them assume they will be reemployed by their firms, come more normal conditions. So you might not have this quite the level of unemployment that you were facing during the Great Depression going forward. So, this 20-25% unemployment number that people are worried about, coming out the next employment report, the expectation is that'll be very temporary, and that by the end of the year, you'll have drawn that back down to something more reasonable.
I know that there was a lot of pushback, but can you please speak to Mitch McConnell's comments about suggesting that states and cities declare bankruptcy?
Well, I think, first of all, I mean, for the legal folks out there, I mean, they know that, states are sovereign, under the Constitution. They're not allowed to declare bankruptcy. You would have to, actually create a mechanism for them to actually be able to do that. I think it does identify a tension, which is, states reasonably couldn't have insured themselves against the effects of this pandemic. They couldn't have saved enough money to balance themselves out through this, and they have balanced budget requirements. They can't deficit spend, right, going forward. So you could say that for the insurance costs that they've incurred, this higher spending in Medicaid, higher spending for unemployment insurance, and this drop in revenues, that it's entirely appropriate for the federal government to make them whole over this period of time, right? To sort of backfill that level of support because the federal government can do that. The bigger issue, I think, though, is you don't want to create this as a blank check, right? So if you've had bad behavior, states that have not shown fiscal discipline going into this, you don't necessarily want to create this as an opportunity to fund all of that, right? So I think what McConnell was alluding to was the fact that, you don't want to give, Illinois $140 billion to make its pension fund whole coming out
Mhm.
of this, because that's something structurally Illinois did to itself. The impact of the cyclical events that have occurred through the pandemic, that's a different issue, and states have and localities have a clear reason to believe that they should get some relief from that.
Now, have you, switching gears, looking at the international front, are you familiar with, and if so, do you have any thoughts on how Europe, specifically the UK, dealt with unemployment, where they are providing 80% of salaries to the workers that were laid off, where we funded companies to try to help prevent people from being laid off. And then there's this expectation, like with United, that people are going to be laid off anyway. So, do you have any thoughts on the different approaches?
Yeah, I haven't can't give that I haven't given it that much thought, to be quite honest. I think that in the U.S. response, the first thing was again this notion that what you were facing was the first wave of this was going to be a liquidity issue, right? Which is you just needed to tide people over for a short period of time, 6, 8 weeks, right? And the idea was whatever was the quickest mechanism that you could get money into people's hands would be the smartest thing to do. And so the idea was we had existing mechanisms through the unemployment insurance system where the feds could come in and gross up and give this $600 a week bonus. You had the $1,200 checks being sent out again, largely through the IRS. You had PPP where the money could be delivered directly into bank accounts. So the idea was, what's the fastest way we can get money into people's hands, to sort of bolster thing. I think the bigger issue is that as the duration of this event has dragged on, and the expectation that it will continue to drag on, is that again it shifts from being this liquidity event to being a solvency event, where again this sort of short-term gap financing isn't going to make up for maybe permanent losses of income that people are facing, in which case you may have to try a different approach at that point.
Let me see. Um, I think that we had a speaker from the regional administrator from the SBA, and he talked about how the Great Lakes region was the second largest receiver of federal funds. So can you comment on how the region is doing compared to the rest of the United States as it relates to the fact that we were such a large recipient of SBA money?
Well, again, if you look at sort of the maps I showed earlier, I mean, there's two things. I mean, one, it's great that we were able to get such a large chunk of SBA money. That's, a tribute, frankly, to the firms because, if you talk to the banks, which we obviously have, they've said that, the money went particularly to firms that showed that they were very well managed, really had all their, income statements in line and were able to, show exactly what their financial condition was and that they were sort of put to the front of the line when it came to funding them through PPP. So that's a tribute to the region being able to do that. If you look at the rest of it, is again, we're less exposed to some of the industries that are most key. So we've done a little bit better. Again, manufacturing in most places is going to get online faster. In many cases, it was already essential. We're a more manufacturing heavy region than much of the country. That's going to help us. We're less tourism oriented region than most of the rest of the country. So we were less hurt in terms of that. I mean, clearly there's pockets of that. Chicago, obviously McCormick Place is, a significant, problem for Chicago going forward. As a convention center, we have significant issues that way. But, if you look at the rest of it, we're a somewhat more integrated region that's more manufacturing facing than others and a little bit, potentially probably a tad less exposed. Even on the fiscal stuff, as it showed, we're not as exposed to fiscally sensitive revenues, economically sensitive revenues as other parts of the country. I mean, you look at a state like, Florida where, you only have a sales tax or Texas where you only have a sales tax. You're going to see real effects as those retail sales numbers collapse.
There's a lot of talk, particularly with what we experience with the hospitals and the need for PPE, and the idea that we should do more manufacturing here at home. So what are your thoughts in terms of a national mentality that seems to really be switching from globalism to more isolation from the standpoint of producing what we need here at home, and how that will affect our economy and the global economy?
Yeah, it's a good question. It's one I have to admit I haven't given as much thought to as I probably should. I think the expectation now is that you're going to want to have things sort of in stockpile to you know sort of suggest that you have resources to be able to have resilience throughout systems. I mean, you've had this tension, and again, this is sort of a longer history of the U.S. But as business embraced lean production methodology, the idea was is you didn't want to build up idle stockpiles of anything. You wanted to be able to run as lean and just in time as possible, and there was a sense that you were being penalized for having surplus stuff around. Again, this McKinsey piece I was talking about with the resilience economy is suggesting that that might be a shift, that what you're going to have is firms carrying more inventory than they have historically, building up some of these necessary supplies against some sort of an event that could happen, and feeling comfortable and actually being rewarded in the marketplace for doing this. I mean, that was part of the problem, which is, going into the Great Recession, you were rewarding companies that were the most leveraged, so the ability to push the boundaries of your sort of, the ability to, produce income was what was most highly valued, where now it could be showing that you have actually built-in resilience, that you have reserves, that you have cash on hand, these sorts of things that investors and people are going to value. Same thing will happen for state governments. I mean, state governments that people are going to really look to are going to be the ones who are going to be having, 20% rainy day funds, as part of their normal operations, where before that would have been looked at as been an excessive level of savings.
Incredible. Well, I think we've gotten through all of the questions. And Rick, am I permitted to share the slide deck that you
Oh,
presented?
absolutely.
So if anyone that has participated today is interested in getting a copy of the slides, please email me. Rick, I want to thank you so much for your time and insights. To be a speaker twice in 2020 is pretty phenomenal, your commitment to this organization, and I am very grateful. And I just want to thank everybody for taking the time to support CCAC, be a part of this discussion. I hope you join us on the webinars, generally Tuesdays and Thursdays at 1:30. Sometimes it changes because we like to accommodate the speakers, but do watch your emails and register. And please know that depending on speaker needs, we go back and forth between Zoom and GoToMeetings. So be aware of that. And I certainly wish everybody, Rick, you and your family, and all our CCAC members, please stay healthy, stay strong, and I look forward to keeping in touch with everybody. Thank you so much, everyone. Have a great day. And Rick, from the bottom of my heart, thank you for your good work. And fingers crossed that the next time we see you, it's with solid growth and a rosy future for all of us.